Welcome to our deep dive into today's market intelligence.
Good to be here.
We've got a stack of briefings, research, earnings reports, and we're trying to untangle these crosscurrents.
Definitely.
Our mission today is really understanding this market push-pull dynamic.
Yeah.
You've got these aggressive new U.S. tariffs,
Right?
but then also this growing consensus around potential Fed rate cuts.
And that tension, that's really what's driving the volatility now. It's fascinating.
Yeah.
Saw it yesterday, right? Some relief from specific tariff exemptions, like for TSMC.
Mm-hmm.
But that got, well, pretty quickly overshadowed by these bigger fears.
Yeah.
A multi-front trade war.
And the potential impact is serious.
Oh, yeah. The World Bank's warning, a prolonged trade war could really drag down global growth, maybe shave nearly 0.5% off GDP.
Yeah.
Levels we haven't seen since, what, the 1960s?
Wow. So, okay, what does this mean for market vitals right now? Sentiment seems cautious, mixed.
It is. U.S. futures, European indices are lower. Asia's a bit more varied, though.
And how are investors reacting? What are you seeing?
Well, look at the VIX. The fear gauge.
Yes,
Right.
spiked significantly.
Exactly. Signals real anxiety, people wanting to hedge.
Uh-huh.
And Treasury yields, especially the 2-year, they're trending down.
Reinforcing that dovish Fed outlook.
Totally. Meanwhile, the dollar index, it's strengthened. That puts pressure on commodities priced in dollars.
Let's dig into those tariffs a bit more. This new wave of protectionism, it's pretty substantial.
It really is. We're talking, what, 50% for Brazil?
Yeah, 35% Canada, 25% India, 20% Taiwan, and this sweeping 40% on all transshipped goods.
And the consequences, they go beyond just trade friction, you see. This is potentially reshaping global supply chains.
So it's forcing companies to think more strategically about where they operate.
Precisely. Not just adjusting to higher cost, but maybe rethinking their whole footprint. And we're seeing that flight from risk playing out.
Sectors like IT, financials, energy getting hit harder.
Disproportionately, yeah, because they're so exposed globally. So you see this defensive rotation into, like, healthcare, staples, utilities.
Okay, so swinging to the other side of that tension, the Fed rate cut expectations. They seem pretty strong now.
They are. Rising jobless claims, the labor market cooling off. It builds the case for easing.
But it's not straightforward, is it? There's this unusual political element creeping in.
Absolutely.
Yeah.
You have the president, the vice president, openly criticizing the Fed.
Yep.
Calling it monetary malpractice for not cutting rates.
That's quite direct.
It is, and it coincides with personnel changes. Governor Kugler resigning today, this surprise nomination, Mirren.
Right.
It feels like a direct challenge to central bank independence. And you see strategists reacting. Citi's team is in the weaker dollar camp now.
Looking for value elsewhere, like the won or rupiah.
Exactly. And look at gold's rally. That's powerful hedging against potential worries about, U.S. monetary credibility.
Which brings us to commodities. Stark divergence there, you mentioned. Crude oil's struggling.
Yeah, it's getting hit from multiple angles. Fears about demand destruction from the tariffs.
The stronger dollar we talked about?
Right. Rising global supply from OPEC plus AC, maybe more supply, if those Russia-Ukraine ceasefire talks progress. A lot weighing on crude.
What gold?
Gold surged over 1%, near $3,500 an ounce. It's playing its classic safe haven role.
Fueled by inflation worries, debt concerns.
Weaker dollar outlook, geopolitics, yeah. And even this kind of novel U.S. gold bar tariff shock hitting Switzerland.
Effective refining.
Yeah, key hub. So that gold to oil ratio, it's got a really critical real-time indicator now.
Telling us about stagflation fears, high inflation, slow growth.
Exactly. A rising ratio suggests those concerns are really intensifying.
Okay, and quickly, earnings. Heavy day today. What's the bottom-up view telling us?
Especially around guidance.
Guidance is absolutely king right now. The market's message is pretty clear.
Just beating expectations isn't enough?
Not in this climate. Look at Tempus AI, a big beat and raise. Stock surge pre-market.
Because they raised future forecasts.
Right. Contrast that with, say, Airbnb or Fortinet. They beat earnings but slid anyway. Why? Cautious guidance. So the outlook is everything.
It really is. Even in hot areas like semiconductors, AMD got punished for not delivering NVIDIA-level growth, Supermicro for falling margins. It's a show-me market. Investors want tangible proof of dominant, profitable growth.
So wrapping up, what does this mean for you, the listener? The market's clearly discerning, demanding execution, strong guidance.
Yeah, and maybe it raises a bigger question. In an environment where even things like central bank independence seem challenged, potentially hitting currency stability, well, how should we rethink what safety really looks like, both in portfolios and just our broader economic outlook?